Good morning, hello and welcome to Opening Bell. You're with us on Moneycontrol. It's a Tuesday morning. I'm Surabhi Upadhyay and the cues are looking actually slightly better. There is some green on global screens. Though oil prices, after cooling off quite sharply last night, are again inching higher. It's all about the Strait of Hormuz. President Trump seems to be indicating that he's called upon his coalition of allies to come in and secure the strait. But the allies haven't really exactly given full assurances of any sort of military intervention just yet. But the market is looking at a relief rally. We saw some of that here in India play out at the start of the week, and some of that is extending across global markets today. So lots to talk about. Let's get started with the headlines. The war in West Asia rages as a wave of drones and rocket attacks targets the US Embassy in Baghdad, while the Iranian missile was intercepted over Tel Aviv. European and NATO allies reject Trump's assistance to reopen the Strait of Hormuz. US President Donald Trump again offered timelines for the duration of the war with Iran, saying it will be wrapped up soon. Also, he says it will delay the China trip that he had due because of his need to be in the US during the war. Brent crude oil prices continue to hold above $100 a barrel on worries over supply, with the Strait of Hormuz mostly shut and US allies rebuffing calls to send their warships to help tankers move through the waterway. Meanwhile, US Treasury Secretary Scott Bessent tells CNBC that the US is allowing tankers to sail through the Strait of Hormuz in order to allow supply flow through the world. Stocks on Wall Street closed Monday's trading session higher as major averages rebound on easing oil prices after US said that it would be fine with some Iranian and Indian Chinese ships moving through the Strait of Hormuz. Meanwhile, investors now look ahead to Federal Reserve's two-day policy meeting, which begins today. Asian markets open higher, tracking gains on Wall Street. The GIFT Nifty is indicating a positive start for Indian equities. All right, so let's quickly run through the cues that matter. Like I'm saying, green has been the color on Wall Street and across most of the Asian screens this morning. The Dow last night was up about 0.8%. The S&P 500 put on about 1%. And tech stocks really led the rally. The Nasdaq was the best performing index, up 1.2%. More on that in just a bit. Now, the reason was this sharp decline in Brent oil prices as well as the NYMEX crude, WTI NYMEX. That contract was down about 5% overnight. Brent was down 2.8%. Though this morning oil prices have reversed some of those declines. Brent oil, for what it's worth right now, is still hovering at around $103 a barrel. So what's going on? A lot of back and forth on whether allies will come and join the US in opening the Strait of Hormuz. A lot of European nations, by the way, have given very, very strong statements, either denouncing the thought of any military action, saying that we should have been told first, saying that NATO protocols have not been followed and the US needs to come through those protocols for any kind of assistance in reopening the strait. The short point is that no one knows when that strait is officially opening. Here is what President Trump said on this back and forth, and he was referring to some of the US allies. He said some are very enthusiastic and some are less enthusiastic, and I assume some will not do it. I think we have one or two that will not do it, that we've been protecting for about 40 years at tens of billions of dollars. So he's going on saying that we still don't know when normal traffic can resume through the strait. Scott Bessent claims that US is actually allowing Iranian ships to transit through that strait. Now, the question is who's allowing whom here? He says that we've let that happen back and forth. The Iranians themselves have been allowing some ships. India has been getting some cargoes as well. So both sides staking ownership and claim over the strait. In the meantime, the UAE last evening announced a full closure of airspace as a precautionary measure. Some of that has been undone in the last couple of hours, so it's still very hazy and still confusing. But for what it's worth, markets decided to look at a relief rally yesterday. So oil was down, US yields were down. They were down 4-5 basis points. Obviously, all eyes on the Federal Reserve meeting. We'll get the announcements Thursday morning our time. The dollar was pulling back from 10-month highs. The dollar index even this morning is just slightly below that 100 mark. Now, I was talking about the Nasdaq outperforming. Yesterday, it was all about Nvidia. They held their big mega event, and Jensen Huang is claiming that the company is going to be earning $1 trillion in revenues from orders coming via their Blackwell and the Vera Rubin chip systems. And this would be all the way going into 2027, so sounding very, very positive. The stock was up about 1.5%. Now, will the Nifty recovery continue? That's the question. Yesterday, very smartly, the index at least managed to see that 1% recovery. We are close to 23,400, but people do point out that the next couple of points are going to be interesting to watch. The zone of 23,500 to 7,000 to 23,700. This perhaps could be a bit of a resistance. And FPI selling is still very strong in the morning in the market. Yesterday, they again sold off cash stocks worth about 9,300 crores. The reason the market recovered is that there's strong buy on dips happening. And look at the buying from domestic institutions, mutual funds. I mean, we had a net inflow of almost 12,600 crores yesterday. Strong domestic buying. And of course, the rupee continues to be on the radar. Some recovery on the rupee yesterday. The dollar is a little quiet this morning. So, hopefully we'll see some up move on the Indian currency again. Now, how should you position yourself for a trade today? We have Ajit Mishra joining in from Religare Broking and Aishwarya Dadij, founder and CIO at Fident Asset Management. Thank you so much, Aishwarya and Ajit, for joining in. Good morning to both of you. Let me ask you, Aishwarya. So it's a little, interesting. I mean, are markets around the world only looking at a bit of a relief bounce because markets have been oversold? Because technically, we don't have too many clear positive statements. There's just a lot of rhetoric and a lot of, communication and miscommunication happening from both sides right now, but no hard evidence of the Strait of Hormuz opening.
Yeah, good morning, Surabhi, and good morning to all the viewers. Definitely, there is a lot of noise which is possibly correct or incorrect hovering around and impacting market movement and sentiments. But one thing which I have understood over the last 3-4 days is that initially when the war happened, the idea was clear that Iran want to make sure that the oil prices skyrocket. And that was the way they could have hit on other allies or US and other countries. But at least in the last 2-3 days, the communication which is coming from Iran is basically indicating that they are okay to make the oil move for countries which are not part of it. And if that happens, crude prices going disproportionately higher goes out of the window. So for a country like India, as long as things stays below $110, at least for a month or so before things stabilize, we will be pretty okay. Because if we go above $110, then we possibly have to see retail prices hike for gasoline. And obviously, it will have an impact on CAD and your inflationary data. If you see our inflation data as well as your trade deficit, which came yesterday, there is a clear cut inching up, right? Our trade deficit came at almost $27 billion compared to almost half of it a month back. So if situation goes above 110, things will definitely make worrisome for India. But being an optimist, I believe about the language which is coming out, and if we abide by that, there is possibly that we are inching out of that risk of crude going disproportionately higher. And that is what market taken have cues yesterday, and possibly what we will see today also, that there will be some kind of relief rally before it does settle. We are not saying things are out of the woods, but these are definitely some positive bites for bulls to take care of.
Okay. All right. So for the time being, the bulls are grabbing this opportunity with both hands. Ajit, morning to you. So what's the trading bias? Continue to play for an upward bounce or short the bounce?
Yeah, good morning, Surabhi. So, Surabhi, yesterday, definitely in the latter half, the rebound was sharp, and we saw that the heavyweights, especially from the banking part, which were extremely oversold, participated in the move. So today also is going to be critical that how the banking index performs, because if you talk about the other sectors, IT was under pressure, energy counters slightly were sluggish. So the the role of banking becomes crucial then. And plus today we have the weekly expiry also. 23,500 is still a call writer zone. So we need to see whether we manage to surpass that area in the initial trade and hold. Then probably we may see a further recovery. But positionally, in case if somebody is looking at the market, still we need to see a clear sign of a base formation or a reversal. So until we do that, I feel still a sell on rise market, considering that the crude is again hovering around $103 after the marginal dip, and VIX is still holding around 20 mark. So these indications are still not very favorable. And plus, if you see the rebound in the US market, that was also not very decisive. So I doubt that they can sustain at the higher levels after this recent decline. So majority of the indication positionally are still on the negative side. But yeah, in case if there will be any relief rally rebound, participants should look for reducing their position, especially if they are sitting on a long side, and wait on the sidelines to see for any confirmation of trend continuation.
Okay, all right. So that's going to be the approach. In terms of the up move that we saw yesterday, Ajit, it was a very wide up move, right? A lot of stocks were recovering. Banks also managed to see a big relief rally. Finally, the bank Nifty also got out of the clutches of the bears. Do you expect to see that up move continue on banking stocks and any specific trades here, either on the bank index or on individual banking names? NBFCs, banks.
Private banking majors, particularly SDFC Bank, has rebounded from a very critical support zone. Close around 800 was the zone basically where last time the SDFC Bank, formed a base and then it rebounded. And that also coincides with the zone close to around the weekly 200 days of exponential moving average. So it's a very critical zone to watch out for. And especially that we were seeing the underperformance from the private banking majors earlier also when the banking index was holding strong. So we feel that it's a good opportunity to start accumulating some of the private banking names like Axis, ICICI, SDFC. PSUs, I believe that they might continue to trade with the sideways bias after the strong outperformance, though we have seen a decent rebound in some of the PSUs name also yesterday. But volatility is likely to remain high in the PSU pack. So it means private banking major is something that you should be focusing on. Among the NBFC basket, I still feel that there will be a possibility of further consolidation or maybe profit taking on the higher levels because the pace of decline was comparatively lower within the NBFC space. So we might see further consolidation before any meaningful recovery.
Okay, all right. So more consolidation perhaps, lined up ahead. Aishwarya, very quickly on bank stocks or on large NBFCs, which have been really pummeled in the last couple of days. Any buys?
So I believe, some of this banking stock has been better in expectation of slowdown in GDP and things like that. And you see HDFC Bank and ICICI has gone down 15-20% since this thing started. And if you see operationally, things hasn't deteriorated at all. Indeed, credit growth has picked up. And if you really look at PSU banks in the last 4 months or so, what we have heard meeting a lot of this managements, the focus on growth is very high. They actually been very, very competitive and giving tough time to private banks also. So the whole pie of credit growth is inching up. Deposit mobilization is also gaining a lot of strength. There are some pockets of MFI because of the state election. There's a worry over there. But if this gas thing doesn't deteriorate further, we don't want to see even a credit risk inching up. So we believe BFSI giving an opportunity in that space currently. And I will stay more with private banks as of now because obviously we know that PSU has a large share of treasury income, which is more volatile as we see the yield moves things around here and there. But definitely we believe that BFSI allocation both to private banks as well as large NBFCs like Shriram Finance, which is a part of our portfolio, and other players can create alpha at least from next 6 month to 1 year perspective.
Okay, all right. So there you go. Some thoughts on bank stocks. By the way, we have a couple of people viewers joining us on our YouTube feed as well. Narendra, good morning. I think you've already got your answer. Bank stocks, you've heard it from both the guests. And Sai Bharadwaj was asking about the Bank Nifty resistance. Again, you got the trades with Ajit. Ajit, if you could just recap the levels specifically on the Bank Nifty. Which are the next set of hurdles that the index will have to cross to ensure that, okay, we can say that this bear trend, at least for the time being, seems to be reversing?
So, Surabhi, last time when we tested this zone close to around 53,400 mark, the zone was coincides with multiple supports. Means we have the 100 days of exponential moving average on the weekly chart, the last neckline area of the previous consolidation zone. So both levels, though we have penetrated that mark briefly intraday, but we could manage to hold that area. So as long as we are holding above this 53,400 mark, possibility of consolidation followed by a rebound is high. On the higher side, 55,000 is still a call writer zone. So the moment we surpass this, then probably it might trigger further recovery or short covering trade. which can help the banking index to inch toward 55,700, 56,000 levels. So as of now, banking looks comparatively better, if we compare it to the Nifty, and 53,400, that should be the stop loss in case if you're carrying longs.
Okay. All right. Got that point. Let's do one thing. We have more questions coming up on YouTube and we will keep addressing our viewers' queries. But for the time being, let's also talk about the key stocks that are going to be in news today. Plenty of order wins and some other announcements as well. So let me run through today's list. So GMDC is the first one that's going to be on our radar today. The company has signed an MOU with the NMDC to explore strategic collaboration in the rare earth element sector. So keep GMDC on your radar. The other one that we'll be putting in the spotlight would be RVNL. The company has bagged orders worth about 95 crore rupees from NMDC, so that's going to be on the list. L&T Tech has launched something in partnership with Nvidia. It's an Nvidia-powered AI lung digital twin platform. This is for investigation of advanced respiratory diseases for diagnostics. So let's see. I mean, it's an Nvidia partnership-led launch. So we'll see if the market is getting excited about it or not. There is Sun Pharma, which is going to be in the spotlight as well. The US FDA has accepted the application for Illumia. This is the SBLA application, which is Supplemental Biologics License application for this particular drug, which is used for the treatment of adults having psoriatic arthritis. So it's an arthritis drug, and it's a pretty big one. Sagar Cement is going to be on the radar as well. It's selling a little over 7% stake in Andhra Cements. We're expecting that OFS to go through today. So let's wait and see how that big deal, plays out. Tata Motors has announced a price increase of up to 1.5% on its commercial vehicles fleet. This is going to be effective from the 1st of April. So worth keeping that on your radar as well. And finally, speaking of order wins, Power Mech bagged a large order, 709 crores, almost 710 crores. And this order came in from Adani's for infrastructure management services. So keep Power Mech on the radar as well. And then there's alkyl amines. Some of the disruption because of this West Asia crisis continues to impact companies, and alkyl amines is one of them. It has temporarily suspended manufacturing of methylamines, ethylamines, and their derivatives at 3 of the company's sites because of the force majeure that has been declared. And finally, Bajaj Electricals has acquired the Murphy Richards brand rights worth about 141 crore rupees. So that deal has concluded as well. So it will be interesting to see if there's any reaction on the stock. So plenty of names on the list over here. Going back to our experts here, let me ask you about auto names, Aishwarya. Tata Motors, I don't know how much of this price hike really helps sentiment, at least for the CV side, Tata Motors CV. But even otherwise, every part of auto came under serious thrashing in the last couple of days. Would you be using these lower levels to buy into anything, and a specific call on Tata Motors CV?
So obviously, auto sector is one which has been impacted the most. If we see majority of stock, whether it is Mahindra's, Maruti, Tata Motor, PV, CV have gone between 15 to 20% decline. And the reason is obviously the rising crude prices, the impact of it, the uncertainty around interest rate and things like that. Specifically to Tata Motors CV, where we have seen this price increase, it is basically to mitigate the impact of raw material price increase. If we have seen in this YTD, majority of HRC prices and other steel prices have gone up 15 to 20%. And the idea over here is to mitigate that and not to lose market share on account of the price increase. But having said that, we believe, Auto Inc. and Auto OEM both are providing opportunities in the whole space. Even players in two-wheeler space, players like TVS Motors and Mahindra have gone down 15-20%, where if you look at the monthly volumes and other numbers, there has not been a dent. So we believe, the valuations which were obviously a bit stretched are coming back to senses. And once we are out of this whole thesis, at least say 2-3 months down the line, we will definitely see this catch up on account of the improvement in their operational performance. Only thing I'm really worried about is how the metal as an commodity does, and it will have an impact on Auto Inc. and Auto OEM. And if you have seen, both aluminium and steel prices has been on an upward trend. and thing doesn't settle, that will have definitely an impact on operating margins. But I think the stock prices have taken adversely the sentiment much more pronounced than what the impact on margins will be. And that's why we believe there's an opportunity in the auto space to create wealth in the coming times.
Okay, all right, got that point. Actually, since we're talking autos, we've got some more questions here. Shyam is asking, morning Shyam, he's asking about Tata Motors passenger vehicles. We just discussed CV. He's talking about PV as well. Shyam, I'll take your KPIT question maybe a little later. Let's talk about Tata Motors PV. Let me ask Ajit as well. Ajit, technically, after this fall, which auto stocks, and now this is a question not necessarily for very short-term trades, but someone who wants to at least keep the stocks in the portfolio for slightly longer, at least a couple of weeks, a couple of months. So does Tata Motors PV, because our viewer here is asking, is it a good time to average? And Tata Motors, at least the PV side of it, it's really been hit horribly hard last couple of, even before the war. I mean, this is going on for the last couple of months now. So is there any sense in averaging Tata Motors PV? And other than that, from a portfolio addition perspective, is there any auto stock that you will pick right now?
So Surabhi, first of all, Tata Motors PV was, like you rightly mentioned, that was underperforming earlier also, while the auto index was hovering around the record highs. It was hovering around its 52-week low with hardly any sign of recovery or rebound, and it didn't participate much even during the strong recovery phases also. So I feel that when the stock was anyways underperforming, and especially when the market situation deteriorates further, especially with the sharp cut in the auto index last week, this Tata Motor PV have in fact breached this crucial support on the weekly and monthly charts also. So there's no point adding to your loss making position. Instead, stock like M&M, TVS, Eicher, the top performers from the auto basket, is something that one should look to accumulate on dips. As you've rightly mentioned, that short-term bias might continue to be lackluster, and there could be a possibility of 3 to 5% of more decline from the current levels. But in case if somebody is looking for medium to long-term perspective, they can definitely look to add the outperformers like M&M, Eicher, TVS with a 6 to 9 month kind of a time horizon.
Okay, all right. By the way, I must point out that some of the markets, because in general, tech stocks in the US did really well, and we've got this commentary from Jensen Huang. Some of the Asian markets, like the Kospi, by the way, is up 2.5% today. That's the extent of gains coming through. And we've started getting our pre-open rates. The first of them are on your screen. So we'll just we'll keep flashing the rates, let them settle. Right now, the Nifty in the pre-open session is suggesting a 300-point gap up. Let's just wait for it to stabilize. Aishwarya, now suddenly, I think the market was just getting bored of the war. It's focusing now on AI and Nvidia all over again, also because of Nvidia's event yesterday, and a lot of bullish commentary coming in from Jensen Huang. Now, typically in the past, when global markets get back on the AI narrative, Indian IT stocks actually suffer. So I don't know, I mean, if you want to draw those correlations today, but there are viewers actually asking about tech stocks. Someone was asking about KPIT specifically. What is your advice on IT, given we have to evaluate everything? The market is still uncertain. There's still a war going on. IT stocks have been thrashed. But yes, there is the very real AI disruption threat as well. So would you buy anything at all? And if you could give our viewer a specific call on KPIT.
Yeah, so obviously IT was hammered even before we entered the war, all thanks to AI and this disruption on the revenue deflationary thing. But what I believe from here onwards, the valuation of IT has come to very, very attractive levels. And if I really see the numbers for the last 3-4 quarters, we haven't seen any kind of a data point where we will have a point of worry. Indeed, if I want to remind all the investors that players like SCL Tech and Infosys actually upgraded their number, right? We have seen recently Happiest Mind came out and said that they will possibly grow higher, more than 10%. We saw the reaction on the stock prices. If you look at a global side, there is no, warning from guys of exchanges or Cognizant. Indian Oracle came and said that the growth will be much higher. So what I'm saying is that the opportunity return on IT is possibly exaggerated. We will possibly see decent growth for the Indian IT players. The AI impact will be there, but it will not come and hit us very hard. It will be very gradual, and Indian IT will adapt to it. So that's our call. So that makes it a very compelling bet that majority of these Indian large IT players are building in a growth of not more than 1.5-2%, right? Where they can easily do 4 to 5% kind of a growth for the foreseeable future. And in that case, the valuations makes a very, I would say, interesting level. If you look at Infosys, TCS, they are trading at 15-16 times PE, which is almost lower than the last 10-year historical level. And if you see the beautiful part of it, especially mentioning KPIT, if you look at the bottom part, mid caps and small caps, I believe their ability to maneuver and grow is much better, and their ability to adjust around this whole AI saga will be much easier for them to play around. So I believe mid cap IT, especially players like Persistent, or possibly to an extent Emphasis and players like that, can get that growth going and adapt to that AI thing. Specifically on KPIT, it's more to do with auto play, and I believe KPIT will do well once we will see that the whole this risk of sentiment globally take a back seat, and that will be a travel. So it's similar to if you go for Coforge, travel is a large part of it, like KPIT auto has a large part to it, and both of them will see much respite coming to them once we see these geopolitical things taking a back seat. But for other IT players, I believe the time is now, to want to go and invest, cherry pick those stock, whether large cap, mid cap, and if you have a 1 year view plus, possibly this defensive bet can create much better alpha for investors. And last but not the least, I believe the recovery in IT will be very swift. Even if yesterday we saw a guy like Persistent show a very sharp turn in market recovered. So watch out on that piece.
Okay, so Aishwarya is a little optimistic on IT. By the way, the pre-open session has settled. So let's take a look at the final race and then get today's day trades with Ajit. So now the Nifty is suggesting that we'll probably start up somewhere around 100 points. That's the indication. And if you take a look at stocks that are leading this up move, at least right now, Hindalco, Bajaj Finserv, HDFC Bank, there is Tech Mahindra, there is Axis Bank, BEL. So it's really cutting across sectoral lines. Sun Pharma, Geo Financial, lots of names, different names. These are all the Nifty gainers at this point in time that I'm pointing out. So yeah, those are the gainers coming up. You have a fair amount of metals, some banks on that screen, some IT on that screen as well. On the flip side, not too many stocks actually down. Maybe a Kotak Mahindra Bank and Lever at this juncture, slightly soft on the losers tally. 80 points up on the pre-open session. Some of the other stocks on the gaining screen include something like WeWork India, Kalpatru, Keystone Realtors, Bejel Projects, which was up 20% yesterday after that order win, is still going strong in the pre-open session. It's up about 3.5% again. So those are some of the stocks. We'll keep flashing the gainers and losers for you on the mid-cap screen as well. Ajit, so now that you've seen the pre-open session, what's the call? Let's go back and revisit the index trades, Nifty or Bank Nifty. Is there a trade? And otherwise your stock trades.
This will be like what we have discussed at the beginning, that 23,500, the call writer zone. So we are opening below that mark is what the indications are. So probably, we might see a lackluster trade, means around that area. We might again see profit taking coming in. Because today being the weekly expiry, the call writers might continue to hold that area. And probably close to around 23,200, 23,100 mark, we might get a buying opportunity as well. So broadly play this range, so closer to around 23,500, one can look for shorting opportunities as well, with 100 point as a stop loss. Now coming to the stock specific views, energy as a basket definitely looks promising to us. Means if you exclude the OMC part, rest of the counters are definitely showing, especially the power names, strong traction, continued traction with volumes. So Coal India is one such name. Where after a strong up move, there's a marginal dip. So one should consider this as a buying opportunity, considering this overall bullish structure. And 478 is what we are eyeing as the immediate target, with stop at 445. At the same time, do maintain few shorts also. So while the pharma basket looks okay to us, Cipla is underperforming within this space. The stock is set for a fresh breakdown after a very tight range of consolidation. So where we see a potential of further decline towards 1230 area. So here one can go short with 1340 as a stop loss in Sipla.
Okay. All right, Ajit, finally, before we let you go, just, going back on that IT question, because a lot of our viewers are still asking about it. Mid-cap IT, I'm seeing Harshraj saying Zensar Tech, Saxoft, any of these stocks that can be bought. Anything on IT, even short-term trades, large cap or mid-cap?
Yeah, so TCS is retested its very major supports close to around 2400 mark after this sharp decline, and the Nifty IT index also Surabhi looks extremely oversold. So we are seeing a strong divergence here. Also, there could be a possibility of a rebound. So if somebody wish to play a recovery trade, then TCS definitely looks okay to us with 2550 as a target zone, with 2380 being the stop loss.
Okay, all right, got it. Thank you very much for that, Ajit. Have a good trading session, and thank you so much for all the trading advice that you've given our viewers today. Thank you. Well, since we were talking IT, I just want to reiterate that a lot of this optimism is really stemming from the US. We had the Nasdaq do fairly well last night. It was the best performing US index, 1.2% up. And there was this event, the Nvidia GTC conference, where Mr. Juan Jensen again gave some pretty big targets. He said that his chips, the latest ones, that is Blackwell and the next series, it could be fetching the company almost $1 trillion in revenue by 2027. Take a look.
Last year, at this time, I said that where I stood at that moment in time, we saw about $500 billion. We saw $500 billion of very high confidence demand and purchase orders for Blackwell and Rubin through 2026. I said that last year. Now, I don't know if you guys feel the same way, but $500 billion is an enormous amount of revenue. Not one impressed. I know why you're not impressed, because all of you had record years. Well, I'm here to tell you that right now where I stand, a few short months after GTC DC, 1 year after last GTC, right here where I stand, I see through 2027 at least $1 trillion.
Well, when Jensen Huang says he'll be earning $1 trillion in revenue, that is Nvidia, the world listens, and that's exactly what's happened. A lot of Asian stocks, tech stocks that is, and chip-related stocks, very, very excited this morning as well. Aishwarya, okay, let's come back. Let's come back to our screen and our markets. You know, a viewer has been asking about L&T. Again, stocks that have been absolutely battered and bruised, out of shape. And the thing is that in this fall, a lot of people would have bought L&T, but they've then had to deal with lower and lower and lower levels because the fall continued on the stock. Your thoughts on where it is right now, whether it should be accumulated, and what kind of time horizon are we looking at in terms of making good on this investment? Because it is, I mean, the reality is that it is exposed to West Asia, and we don't have an end date in sight just yet to the war and the hostilities.
So, if you really look at market now is not really focused on war, it is more focused on oil prices, right? And if we get clarity on how oil prices moves, looking at the intention of both Iran and US, the recovery in the global market, including India, would be swift. Having said that, this will be more sector specific, right? Obviously, Larsen, which has a higher exposure to major part of his order book, or both and as well as execution, has an exposure to Middle East, but that uncertainty over that Middle East can sustain further even if the crude prices goes down. That is very, very critical. So what I understand is, that the most majority of the investors want to play the rebuilding thesis of GCC countries, where Larsen would be a big contributor, but it can at least play out little late. It might happen 6 months, 1 year, or even 1.5, 2 years down the line. So, I don't believe that this war-related activities will settle anytime soon. And if that happens, we will possibly see a couple of quarters of tough numbers for Larsen, and even order book shrinking, and market is still will react to those numbers when they hit the screen and all of that. So I would tell investors to go slow on adding a Larsen at this juncture. That even if the market recovers, L&T recovery would be a bit let back, and the uncertainty will be there in the GCC. I would rather play more of industrial exposure, which are more developed, exposed to India as a theme. Obviously, Larsen obviously has a large play in India, but more specific to India, because if you really look at the order book, if you look at, if actually, should be a lot of management which I have met over the last 1 year. Say there were 60, 70 management companies which I have met. I would say 95% of them, when they talk about the expansions, the capex that they're
Sure.
talking about, is significant. And let's play that story through a lot of
Sure.
these players in India, which is what can make wealth for investors.
Okay. All right. Aishwarya, thank you very much for joining us today. Good to have that advice. I hope you have a good session today. And let's see if the market is going to be a little charitable to the bulls. At least yesterday they got some green. And the start right now is on the positive side. Thanks for being with us today. Okay, so we are exactly a minute. Thank you. We're exactly a minute away from market opening. The rupee has opened with a slight positive bias. I mean, it's not like running away. There's no big rally or anything. But, at least it's better off than the levels of almost 92.50 that were being hit last week. Nikunj Saraf, CEO at Choice Wealth, is with us. Nikunj, good morning. Just getting our equity first trades now. But before we, talk about the rest of the market, on the currency, what's your call? What is the immediate trading range that you see for the rupee?
Good morning. The range is going to be around this only. Just to start with, this basically it has come because of this crude oil phenomena that is going on, and every $10% increase in crude oil, it is impacting a lot on the currency. So the levels should be around this only, where it is trading today as well. It has opened with little on the north, but I don't think there is a major scope on that side as well.
Okay, all right. Just stay on, Nikunj. The market has opened, so let's see where things are. 30 points up, 20, 29 points up. So we're not getting too much of enthusiasm. It's a very, very measured start. 15, 16, 12 points higher now. Little volatile. The mid-cap index is absolutely flat. The bank Nifty is also fairly quiet. You can see there are not very clear, directional indicators at this point in time. It's neither a big gap up nor a gap down. It's just a cautious and quiet start. Let's talk about stocks. So what do we see on the green side of the screen? Tata Steel, Eternal, Interglobe Aviation, ICICI Bank. These are the early movers on the way up. I can see JSW Steel as well. There is Asian Paints, there's Dr. Reddy's. But that's about it, because, there are, right now on the Nifty, there's not even one stock that's up more than 1%. So that's the level of caution that we're talking about. You can barely see some green on these names right now. So things are changing quite quickly. ICICI Bank is the winner on the index. ICICI Bank is up about 0.5% at least at this juncture. The Nifty, by the way, has turned negative already. So we should look at the losers. Nifty is down now 23 points. And the losers are on your screen. Some of them are on the IT side. And that's exactly what I was discussing with Aishwarya. Every time the world moves to the AI story, our IT stocks have been thrashed in the past. And at least that's the sentiment right now. So it's not like you have a major AI rally in the West and then our IT stocks go up. No, because there's no comparison. It's just sort of chalk and cheese over there. So Infosys, HCL Tech, Wipro, all of those stocks are down. What else? Eicher Motors is slightly lower. Bajaj Auto is lower. HUL, Tech Mahindra, Ultratech Cement. A lot of the cement stocks were doing well yesterday, but today there's some profit taking going on. Titan, Trent from the consumer pack. Both of those stocks are lower. So let's keep flashing. Yeah, so more losers coming up on your screen on the Nifty. 17 points down. Like I'm saying, it's not like a slide or anything. It's just flip-flopping, little red, little green. But there is a lot of caution in the market. No taking away from that. ITC, TCS, HDFC Bank, all these stocks are down between 0.25% 0.5%, somewhere in that range. So it's a very, very quiet morning of trade, at least for now. Okay, let's see what's happening beyond the Nifty 50. Do we see any meaningful gainers here? There's Kalpatru, which is up about 6%. PowerMech won a project, I think a 700 crore rupee value roughly of that order. So that one's up about 3%. Bajaj Electric, which is now going to be owning the Murphy Richards brand, is up about 4.5%. It was a stock on our trading list. Let's get to the individual stock names now. So these are some of the names which are on the upside. Kalpatru, PowerMech, Bajaj Electric. These are the stocks that should be on the radar. On the downside, we've got names like IDBI Bank. IDBI is still struggling, I think. Yesterday it was absolutely battered, blue. The opening this morning was a little cautious again. What else do we have? A couple of the financial names like IIFL Finance, a little bit of red on it. And that's about it. It's very, very quiet. Brainbees solution. We've the Oberoi Realty. Let's see if we can get Oberoi Realty on the screen. Oberoi is in news because it has signed up a development with Mahada, a plot development with Mahada. This is for Versova, and it's a pretty large parcel of land which Oberoi is going to be developing. That stock's up about 1%, at least at this point in time. So, that's where things stand. Okay, so let's go back to our conversation with Nikunj. Nikunj, what's the sense? I mean, you're saying the currency is going to be in that trading range currently. So has the market kind of entered a still zone? Because, and that's actually, maybe it's a good thing. It's a good thing. We're not seeing dramatic escalation in the war. There's a lot of back and forth on the Strait of Hormuz, whether it's going to open, not open. But at least markets around the world and here in India, at least they have stopped falling. Is that the first indication that we're close to the bottom?
So I feel till the time there are no more escalations, the markets are going to be around this range, and that is how even the rupee is going to be. So you see, it is back on 90 to 42. But see, again, the most impactful is going to be the crude. So Brent crude, whatever the price comes down, that is directly going to impact the rupee term. So let's see in the next 7 days how things turn up. But even you see last 2-3 days, there has been some kind of escalations. Yesterday also they again hit back on UAE. There has been, but still the Strait of Hormuz, they have opened up kind of for what they say, basically that for the countries other than their enemies. But still the pressure is going to be there, and till the time Brent crude doesn't get back to the at least 10-20% down, there's not going to be any pressure raising, and the markets are going to be around that level.
And I guess Brent crude can only fall 10-20% if the Strait actually meaningfully opens, right? If just the geopolitical risk diminishes, how else will crude fall that much?
Yeah, so there has to be de-escalation, not only just opening up the route. The de-escalation has to be there because they are continuously firing on the various ports at both the sides. Even 2 days back, the Fujairah, the biggest port in the UAE, was again hit back. So till the time there is this escalation, and also the strait has to be opened, but it is not looking good. At least last 3-4 days talks also not looking very positive.
Yeah, since we're talking oil prices and we're talking about the currency reacting to all of this, I want to pull up the statement that we got from Fatih Birol, the director of the International Energy Agency. He's actually saying that there could be a release of additional reserves. Now, remember, the IEA has already announced the release of these 400 million barrels. Mr. Birol talks about how this oil will start flowing to the markets, and he says that more such strategic releases may be needed as well. Just listen to him.
Dear colleagues, as I speak now, as a result of IEA action, additional barrels of oil are flowing to the market in Asia. And on top of those barrels being released right now, more and more are coming from IEA emergency reserves, both crude oil and oil products. In total, from the IEA collective action, countries in Asia Pacific have committed to release well over 100 million barrels. In Europe, a similar amount. And in Americas, countries are releasing over 170 million barrels, with more additional supply coming over 20 million barrels from increased production. We are coordinating closely with all our member countries to ensure that the oil stocks they have agreed to release reach the market in a timely manner. We are closely monitoring this process. The war in the Middle East is creating the largest supply disruption in the history of the global oil market. The volume of oil supply now offline is already higher than the supply loss during the oil shock of 1973 and higher than any of the big disruptions we have witnessed since then.
Right, that's the IEA talking about how they're doing their bit to keep the market well supplied. Well, prices are where they are, still northwards of $100 a barrel. So, Nikunj, before we let you go, what's the final advice for traders out there, whether they're looking at oil or the rupee? Should you be initiating any kind of long trades at all? Or, basically, how do you navigate this? Because it's not over and there's still plenty of uncertainty.
There has to be caution maintained right now, whatever the situations are there, unless and until some positive signs start coming up. Yeah, but for people who are investing for a very long term, these are levels very good. Nifty Sensex almost at 20p now. These levels look very good to get started with the investments. So these levels are very good with that perspective. But for the traders on the crude side and as well on the rupee, there has to be some caution to be maintained till the time there is exactly some good news start coming in. But that looks far-fetched now.
Okay. All right, Nikunj, we'll leave it on that note. Thanks very much for joining us today for a quick comment. That's the way the oil markets are shaping up and the rupee markets as well. The rupee, let's pull up dollar rupee actually, 92.42. So, yeah, there's a little bit of cool off on the dollar index like we've been saying. The dollar index is below 100, but it's not like the rupee is having some runaway rally because things are still confusing and still fairly tentative. Rupee at around 92.42 versus the dollar today. Okay, with that, let's come back to the equity space and talk about, fundamentally how we need to look at our portfolios in a market which has been absolutely whipsawed. Well, who better than Mr. A. Balasubramaniam to put that question to MD and CEO of Aditya Birla Sun Life AMC. Bala, good morning. It's a pleasure to be interacting with you. I think first time you and I are talking on Moneycontrol, so this is a new digital platform. But I'm so glad you're here. Good morning to you.
I think it's for the second time I'm coming. I think we had our first session with you once you
budget, around budget.
Yeah, the budget. Correct,
yes,
correct.
Yes, around budget day, just around budget
thank
day.
You for having
correct.
We spoke then. Yeah.
So, Bala, I mean, so much has happened, right? Early February, life seemed very good for investors. We had all the positive commentary, the trade deal had been signed, earnings were looking good. And everybody was talking about how this has to be a much better year. But now here we are with so much of geopolitical uncertainty. So what would you start off with? What would your opening advice and opening statement be to investors?
Yeah, I think historically I've seen whenever, of course, we go through our own challenging period, I think we figure out how India should come out as a reasonably, more than calling it as a winner, reasonably successful weathering around the uncertainty and take some kind of measures that will make India reinvent themselves to look at long-term sustainability of India's story from the overseas investors' point of view. Historically, that's why I've seen after every crisis that hits the global market, whether it is to the oil, whether it's a geopolitical risk, or any other means coming from currency and other such stuffs. And the last 4-5 years of inclusive growth in India predominantly is driven towards that. And I think making India more self-sustainable, especially in the sectors like energy, manufacturing, self-defense investment, and semiconductor investments, as of late we have been doing. EMS, electronic manufacturing sectors, for significant pickup that has happened. All of them actually are more towards making India more resilient from the global economic volatility. But having said that, we have to accept the fact that dependency on oil is not just only for India. Globally, dependency on oil is pretty high, whether it is China or India. Most of the global economies have got very high dependence on fuel, especially oil and gas. And given the fact that these one commodities have gone up quite sharply to the current geopolitical risk, it would have some kind of impact, which I think we have to weather around, which will come in the form of inflation rising. Input cost will go up, and as a result of that, inflation will go up, and therefore monetary policy authorities, which have been extremely supportive on Indian economy for the last 2-3 years, they may have to actually revisit their own policy framework in order to ensure that that we are able to contain the volatility, and yet start building up the necessary framework that will make it future more bright for us. I think the trade deal that we are saying, as we speak, I think India continued to pursue the free trade agreement with most of the countries, whether it is US, even recently Malaysia and other countries. Now this has been at the job they are already doing it. So therefore, these are something continuing. I'm sure would have its own long-term positive impact. But at this point of time, the current uncertainty, I don't think, can be ignored. One doesn't know how long this will sustain. And second, even if it comes back, whether the peace will return as fast as what would I expect, it's also something that remains to be seen.
So, Bala, I think the question before a lot of investors is when to deploy. And I know no one should try to time the market, but people typically try and do that. I mean, is this the time to go all in? Or do you think that this will continue to be a very rocky year? So you should stagger out your purchases. So the question between SIPs or lump sum, and maybe SIPs continue, everybody SIPs continue. But I think the question right now is lump sum. Yes or no right now?
So I think the way I see is people should start looking at lump sum at this point of time. The reason is very simple. Just about a year back, what was the concern that was there for the Indian equity capital market is the valuations. I think people started feeling that Indian market has run up ahead of time, earnings have to catch up, and the PE multiples are pretty high. And the market has already gone through probably, I would say, 2.5 years of time value correction. If you take any sector that you take, have gone through a time value correction, so whether it is right from banking and financial sector to all sectors, have gone through their own period of corrections, which essentially means the valuations now come to a reasonably good level. I think it's even, I would say, below the long-term average, especially with the recent correction that you have seen in Nifty and rest of the market, including small and mid-cap. I would say valuations come to a reasonably good level. But probably one of the question marks that will still remain is whether the earnings at all will pick up in the next 2-3 quarters for one to jump and then start buying. I would assume it's very difficult to predict when things will turn positive. If the oil prices, assuming scenario, the Iran war comes to an end and the oil price crashes to roughly about $70 to $80, as long as the oil moves between $65 to $75, I think India's ability to grow faster, I think, would be far higher. Therefore, the market can give a knee-jerk upside as well as we have seen in the knee-jerk downside. Therefore, I would assume, as it stands today, taking advantage of the current market correction, which will almost come to the level at which I would probably assume it has to find a lot of support. So it's a good time to invest in now through the lump sum, through the flexi-cap fund, small and mid-cap fund, even multi-cap fund. Could be a good opportunity for people to start looking at lump sum. Of course, SIP is always the way of investing, it remains. At the same time, STP way of investing still remains. But having said that, lump sum could be considered at this point of time. Again, coming to the same point, that whatever the valuation concern which was there as a hanging sword for 2 years, now it's no more, we can say that valuation concern continues to remain from the broader market point of view.
Okay, so this is the time to go all in and probably allocate some lump sum capital as well if you do have some additional capital on the side. Bala, so that's on the equity bit. Now, people will also wonder how to divide that money because I think equities have been so difficult over the last almost now 15, 18 months. That therefore the FOMO and therefore people move to gold and silver ETFs. A lot of people are still trying to invest in overseas markets, though not too many funds are taking money. So what should the division of capital be like? And I mean, this obviously you have to look at your overall asset allocation. But I'm saying right now, looking at markets, anyone who's investing that fresh lump sum, is it prudent to go all in equities, or should you be in some commodities as well, and or maybe just in do a lump sum in hybrid funds instead?
Yeah, I think the lump sum could be. I think the beauty of our industry has invented a product such as the balance advantage fund, which invest in equity depending upon where the market outlook is, up to a percentage about ranging from 55 to 65%. But as it stands today, the balance advantage fund would have about 53-54% in equity. As they start seeing outlook for equity improving, then naturally they'll go up to about 65 to 70% dynamically managed fund. Therefore, any investors who are sitting on the fence and not knowing exactly about where to put the money, I think they should, ideally speaking, park large pool of money, which is a lump sum money in the balance advantage fund. That's, I think, best way of taking entry. The second, of course, is the market, in my own belief, is having seen reasonably good correction across the market, not just only large cap or mid cap, small cap. Across the market, we have seen good corrections. Whenever the market bounces back, it will start from a large cap, then it will go down to the mid and small cap. Therefore, flexi cap fund could be the another option that investors should choose between flexi cap fund and multi cap fund. Either should choose that. As far as the commodity is concerned, clearly volatility could be quite high. Right now, gold is an investment which is being held. One as a dollar-based investing. The risk arising out of the inflation is also going under the gold as a thing. Gold as a commodity. I think silver as a commodity has been extremely volatile. People can actually burn the finger if they get it wrong. Therefore, the best way to place the commodities to the multi-asset allocation fund, which invest in across asset classes, including gold and silver to the extent of about 10 to 15%, and REIT and NV to the extent of about 5 to 7%. And rest of it is coming in the fixed income and equity. Therefore, multi-asset allocation fund also could be another choice. I think in order to make it very clear, I think to start with, balance advantage fund could be a good option to pump in, right, as it stands today. And then take exposure to the flexi cap fund. Other funds can be considered as it gets evolved in terms of outlook changing. As the outlook gets evolved as we move forward.
Okay. Bala, finally, I want to end with IT stocks. And by the way, IT stocks are falling the most today. Wipro, Infosys, HCL Tech, all of them are down 2, 3, 4%. When twin reasons, you can argue that, okay, IT relatively was falling less when the overall market was selling off. But more importantly, we have this AI enthusiasm back in global markets because of what Mr. Huang said. Mr. Huang is saying he'll be earning $1 trillion in revenue, Nvidia that is, with all his chips, the new ones that he's launching. And we've seen that, right, Bala, every time global markets get on the IT, or not the IT, the AI bandwagon, we've seen the way our IT stocks have suffered. What would your advice be to people who either invested in IT funds or were heavily indexed in on IT, and they, people also were buying the dip, buying the fall? What are your thoughts? Because this is again a very fragile side, a very fragile sector, given the disruption.
Yeah, of course, this industry is currently put to a lot of challenges on the back of AI, which will ultimately lead to the replacement of existing model with the new model. But having said that, having seen significant underperformance the last, say, not just 1 or 2 years, almost, but 5 years underperformance, on the back of the uncertainty that the industry is facing, and also having seen the industry have always rediscovered themselves, adapt to the new model, setting up a division that could help companies actually to adapt to the new AI model, which is what I think most of the large companies are trying to do. Therefore, I would assume the new model in which they'll also be working will make them more survivable for the future. So therefore, going by the correction that we are seeing, probably I would assume in the IT companies, valuations become, it's all become a value play. Second, I would say in some sense, a contra investing could also be applied. Going by that principles, I would assume one can be very selective in terms of picking stocks in this space, purely on the basis of those companies who have got wherewithal to overcome these kind of issues in the past and they revived and come out as a big winner, as large names in the industry. And we as a fund house have been taking this contra bet selectively in some of our schemes. I would assume the sectors could potentially be an outperformer as we start seeing in times to come. So that's why we are saying it. From industrial point of view, of course, not many have come into the digital fund. Very few have come as part of thematic investing as part of the overall portfolio. From industrial point of view, I would assume better they stay invested in the diversified equity funds rather than going for any thematic funds as it stands today. Because the overall market itself more favorable for investing across the market, better to be across different sectors rather than a single sector exposure, which the investors should take.
Okay. All right. That's advice well taken. Thank you, Bala, very much for joining in. Good to get your perspective. And I think it's just, it's good. People can sit back and kind of think about how they want to invest, where they want to invest, and how they want to balance out their portfolios in a market that continues to be fairly volatile. Thank you for this. Have a fantastic day, and we look forward to more conversations.
Thank you. Thank you.
Thank you. Thank you. Okay. By the way, let's look at the market once again before we wrap up today's edition of Opening Bell. The market has been volatile and it's been constantly flip-flopping between negative and positive. Right now, there's some green on the screen. So you can see we opened positive, slipped into negative territory. Now there's a bit of a upsurge on the Nifty. So the thing is that beyond IT, large cap IT, the rest of the market is more or less okay. Let's talk about where the gains are. Let's flash Nifty gainers for you. Bank Nifty is still a problem, and that's because of State Bank of India largely. But the gainers on the Nifty include names like Eternal. Couple of auto stocks are doing very well. Mahindra and Mahindra, Maruti Suzuki, these auto stocks are having a very decent morning. Tata Steel, Bharti Airtel, Interglobe Aviation, these are some of the other names which are bringing up the winning tally. ICICI Bank is on the upside. So the Bank Nifty is down because things are split down the middle. There's ICICI Bank, which is taking things higher, and SBI is on the other side, which is lower. There's also Reliance Industries, which is really helping the bulls case, at least for the time being. Reliance is positive, about 0.5% up, and that explains this 0.25% gain on the Nifty. Now, if you take a look at the negative side of the screen, let's pull up the Nifty losers. That's where you'll find lots of IT stocks. Wipro, Infosys, HCL Tech, Tech Mahindra, all of them actually. I mean, all of the Nifty laggards tally is made up of IT stocks largely. And then you have a couple of names like HDFC Bank and SBI, which are sulking slightly, but not much. SBI is down 0.5%. HDFC Bank is down less than 0.25%. But that explains why overall the Bank Nifty is still negative. But otherwise, let's see. It's still, anyone's call today between the bulls and the bears. It's a very even fight, at least as of now, this morning. The question is really what next in terms of the battle in West Asia, in terms of the way the US is looking at its own approach, its policy in this war. We'll keep flashing the stocks for you, but our next conversation is coming up with my colleague from Moneycontrol Pro, Neha Dave, who's been looking at just how strategically US is evolving its policy around this war. And before I get, hi Neha, good morning. That's a nice bright red color you're wearing. Well, Neha,
yeah.
Just give me a second, because before we get started, I thought it'll be a nice context will be to hear President Trump's latest comments on Cuba. Even before he can wrap up the war in West Asia, he started dreaming about Cuba, right? And he made that statement just overnight, saying that I can have it in any way I want. So it was, as usual, a very, very colorful statement. Let's hear out what the US president has to say on the US's designs on Cuba now.
When you say Cuba is next, will that look more like Iran or Venezuela?
Can't tell you that. I can tell you that they're talking to us. It's a failed nation. They have no money, they have no oil, they have no nothing. They have nice land. They have nice landscape, It's a beautiful island, But I think Cuba's seen the end. You know, all my life I've been hearing about the United States and Cuba. When will the United States do it? I do believe I'll be having the honor of taking Cuba. That'd be good. That's a big honor.
Taking Cuba.
Taking Cuba in some form, yeah. Taking Cuba. I mean, whether I free it, take it, I think I could do anything I want with it. You want to know the truth? They're a very weakened nation right now. They were for a long time. Very violent leaders. Castro was a very violent leader. His brother's a very violent leader. Extremely violent. That's how they governed. They governed with violence. But a lot of people would like to go back.
So there you go. Okay, yeah, let's just come back to Cuba. We'll talk about his comments on the Strait of Hormuz a little later. Neha, I mean, what do you make of it? He says, I can take it, I can do whatever I want with it, and I can free it, I can own it. This is a country we're talking about. But then that's the US president for you, right? There was Venezuela. There's this war in Iran that I think nobody in the world really thought will play out in this manner. Now he's asking for his allies to help out, open that strait, which is still not open, and he's already moving on to Cuba. Your thoughts on what's happening with US policy, if there is any thought to it at all?
Yeah, so, I mean, very interesting and difficult times that we are seeing today. So US is sending some mixed signals as far as the West Asia war is concerned. The global consensus about the West Asia war today is that it will turn out to be a taco, which means US has escalated this, but it is quickly looking for the ways to de-escalate the situation. It has been more than 2 weeks since US and Israel jointly launched strikes on Iran. And within these 2 weeks, we have seen that it has escalated. The entire thing in the Middle East has escalated. And more importantly, where it is pinching US and the global economy is that economic cost of this war is huge. The fallout is huge, as we have seen in oil prices, which has spiked to a level which is unsustainable for many economies globally. Also, because the equity markets also have seen a sharp fall. Now, where it hits US is that US is the least vulnerable as far as the oil impact is concerned. That is because it is the largest producer of oil and it is a net energy exporter. Having said that, if oil continues to remain above $100 or around $100, it will start getting reflected in US's CPI inflation. That is because the gasoline prices, which is something which is consumed by the households, that is go up, and households will start feeling the pinch of the higher oil prices because of the Middle East war. And going into the midterm elections, which is something less than 8 months away, this is the least thing that Trump or US president would want, where households get increasingly uncomfortable with the cost of living. Also, it can impact US's growth numbers. See, as far as the growth is concerned, the consensus growth, GDP growth estimated for US is for 2026 is around 2.2%. US might get some benefit on the growth side because again, it is a net energy exporter. Having said that, this would, the higher gasoline prices would erode the purchasing power and impact the consumption. There are some tax refunds which are lined up, which could offset certain the impact of higher gasoline prices. But having said that, the downside risk to the growth has immensely increased. So despite US being the least vulnerable economy in terms of higher oil prices, will feel the impact, especially since the elections are just away in 8 months. Now the way the situation is unfolding is that US and Israel both had distinct objectives going into the war. What US wanted was to neutralize the nuclear capabilities of Iran, and perhaps for Israel, the most important thing was the regime change. But the way the war has unfolded is nothing closer to what would have been anticipated earlier. And we have seen the disruption in the Strait of Hormuz, probably that was not anticipated. And hence, we have seen US also sorting intervention from other countries globally to help in freeing Strait of Hormuz. The European, what the news are coming is the most of the European countries have declined or are not interested in joining the war in freeing the Strait of Hormuz. So, US will have to quickly look for a way to de-escalate or end the war, mainly because of the midterm elections due in November. Now, if we look at what is happening back home in US, is the Democratic parties have started increasingly talking about the inflation and how it will impact the cost of living for US households. Also, if we remember, Trump's poll promise was to pull out US from all the military conflicts globally, but it is that is what is happening is exactly opposite. So, from a elections perspective, what Trump has a very limited time and also a political room, wherein it can wage more wars. And if the prices continue to sustain, oil prices continue to sustain above 100, it would be difficult for him from going into the midterm elections. So that is how the scenario is unfolding. But more than economic cost or economic fallout, what we believe is that this war will not go into months, primarily because US will look to quickly de-escalate the situation, mainly because of its midterm elections. Trump's approval rating is also trending downwards in the country, and also there is a lot of opinion poll which is suggesting that where the people are not happy of US getting involved in the Middle East crisis.
Okay, all right. So that's that's where we are at for the time being. But I mean, Neha, from an investor perspective, nothing really still seems to be clear, right? Because, or maybe the reason why the market's moving on and it's reacting to things like Nvidia today is that maybe the market feels that this is that taco moment, that we're past the peak, the worst of the geopolitical standoff, and that from here onwards, the US kind of retreats, and then at least there's no escalation. But I don't know if that solves the problem from an investment and investor perspective, because you still have an impasse on oil and on Hormuz, right?
Yes, absolutely. So pulling out from the war might not be unilaterally easy for US, because the situation that has unfolded in Middle East is beyond what US could have envisaged and beyond US's control, especially the disruption in the Strait of Hormuz. And precisely for this reason, US has sought intervention from other countries, but which is again not coming by. So it would be difficult for US to pull out. Having said that, just because going by what is happening, at back home, there are more voices raised by the opposition party, and even within Trump's own fan base, that is MAGA voter base, there is growing discontent about this waging a war in Middle East, which will translate into a higher cost of living for the US citizens. So, precisely for this reason, political reasons, he could look to de-escalate quickly. So, having said that, so obviously the scenarios that globally people are building is not that this war will continue forever, in the sense the way we have seen for Russia and Ukraine. It has been almost 4 years, and despite Trump's intervention and efforts, we have not seen any sign of a peace deal between the two countries. So, but in this case, in the case where the Middle East, as far as the Middle East is concerned, because it has impacted the oil markets, the equity markets, also if you see the way it is impacting US markets. See, there are two things. One is this war has exposed the certain vulnerabilities of the US financial system. The private credit funds, there is a lot of stress. We have seen news of private credit funds stopping the redemption. There is higher investor redemption. Also, as far as the US equity markets are concerned, it is one of the most overweight position globally. The valuations are closer to the record high. It is a crowded trade, and hence, if in the situation where the war continues at this pace, it would cause a lot of volatility in US equities. And this is the least thing that would make perhaps Trump uncomfortable going into the election time in November. So pulling out or de-escalating quickly is one of the outcome which the market is anticipating today. How it will be done, it is very difficult to say, because the very essence of war is uncertainty and unpredictability about the events.
No, absolutely, absolutely. So investors continue to go through these trying times, waiting to see what the next turn really throws up. Neha, thank you. I mean, good to have that perspective, really, as we continue to battle what is an increasingly volatile market. For the time being, though, of course, Neha, thanks very much. You have a good day. Good to have you on the show.
Thank you.
As we're winding down, for the time being, the markets managed to retain some positivity. It's also the Tuesday weekly expiry day. So let's see how things play out, and expect maybe more volatility in the afternoon around 2:30, 3 o'clock. So watch for this. But right now it's a good screen. I mean, we've got a 70-point rally on the Nifty, and even some of the IT stocks, they are trying to recover from the lows of the morning. And a lot of the banking stocks, they are now trying to turn around. So this is where we are pretty much at. So, I'll take your leave at this juncture on this edition of Opening Bell. But as we go, I do want to sign off with Trump's latest statement on the war that has caused all this disruption, that has caused this flare-up in oil prices. The US president reflected on the US actions in the Middle East, and he actually expressed surprise at the way Iran managed to hit back, and the fact that Iran was hitting targets in Gulf nations. He said that it was unexpected and shocking. Take a look, and thank you for watching.
You can't let Iran, who's truly a nation of great terror and power. Look what happened in the last 2 weeks. They weren't supposed to go after all these other countries in the Middle East. Those missiles were set to go after them. So they hit Qatar, Saudi Arabia, UAE, Bahrain, Kuwait. Nobody expected that. We were shocked. And the other one, they fought back. They could have yielded. But think of it, if we weren't around, they had tremendous power. They had thousands of missiles, most of which we've terminated.